Disclaimer: This video is prepared in personal capacity. By no means it is linked to my contractual or non-contractual agreement. Investors are advised to take their own assessment before coming on to conclusion. This video is only for educational purpose and by no means any solicitation, advisory or recommendations.
Hi everyone, in today's video we are discussing about the market linked debenture or says MLD. My aim is to make your investment journey easier, yet one level deeper to understand. I am Shubham Kumar Agrawal, I am a chartered accountant and welcome to my show. MLD are the non-convertible debenture which has a flavor of market. Maybe it is currency, equity or in some cases issuer has their own bouquet of product. Let's understand how it is structured.
Suppose I am an investor and I have to invest 100 rupees in MLD. I'll give money to issuer, which is generally a non-banking financial company or says NBFCs. NBFC will use 80% of sum for extending loans and earns interest, whereas rest 20% of sum will be invested into market options, maybe index options or their own bouquet of stock options. Now let's understand how return will be generated if invested for 3 years. On the loan extended, NBFC will earn interest at 8 to 9% per annum, whereas loan for 80 will turn 100 at end of third year. Now options plays role in delivering the required rate of return to investors. If market does well, there could be a boost on the investments. If it goes down, the impact is limited by the loan portion, which helps protect the principal, especially in principal protected MLDs.
Now there are two types of MLDs, principal protected and non-principal protected. In order to make it more practical, there is a chart on your screen. This is the same payoff sheet which comes with a scheme document. We are standing on a Nifty level of 25,400 and it performed by 8%, 27,432 level. So the product will deliver 0% return. In a IRR terms over the 5 years, 1.5% of Nifty, the product return will be 0. Similarly, if the Nifty performed by 34%, then the return will be 102.5% product. In IRR term, 6% of roughly Nifty performance, the product will deliver 14.5%. Whereas, if it comes down by 30%, say 17,780, then the product return will be minus 42%. In IRR terms, 6.6% of negative return of Nifty, then the product will deliver 9.9% or says 10% negative return. This was an example of market linked debentures which is a non-principal protected. Let's take an example of principal protected market linked debentures. So today we are standing at a level of 17,500 and market rallies by 10%, which is 19,250. Our 10 lakh rupees of investment became 15,35,600 rupees, which is a product return of 53.56% or IRR 13%. Whereas if market goes down, so on, then also our 10 lakh rupees of investment will remain the same of 10 lakh rupees with certain exception. Now let's talk about the taxation on the market linked debentures. As per the relevant section of Income Tax Act, any gain arising due to sale, maturity or redemption will be treated as a short-term capital gains, irrespective of the holding period and listing status, and hence will be taxed as per the investor's marginal tax rate. The taxation places MLD on an equal footing with the other debt instrument like corporate bonds, debt mutual funds or the FDs. Now the question is whether it lacks transparency. In the course of time, SEBI has tried to tighten its regulations in order to make this product more efficient and transparent. But when compared to the other asset classes, there are certain downsides. First is a real-time update of valuations. Second is the option strategy transparency, which is of course a secret sauce of the issuer. Third is a cost involved in the product. Why? Because there is a cap up in the product. So even if the Nifty performed by 3 times, 2 times, whatever, but the product will only deliver what is mentioned in the scheme documents, which is a highest. I hope it was helpful. Thanks for watching. See you next time.